Welcome to another unit in this course on economics. This time I'm going to talk about the capital market, more or less how we can model the capital market, and also which insights, for example, regarding government debt, we can draw from the capital market. And for this, let's start with a simple graphical representation of the capital market. And this diagram already shows a really important aspect, and that's that the supply in the capital market actually in this situation comes from the households saving their money. So they're going to a bank, to the financial markets to save their money. And the demand results from the companies taking credits to finance their investments. So here, as compared to the classical goods market, the roles are reversed. The supply is the households, the demand is the companies or firms. That's the main important aspect regarding supply and demand. Then, regarding the quantity, well, that's the traded capital. And the price for capital, that's the interest rate. That interest rate also determines how many the households save and the amount of quantity or the amount of credits the companies take for investment purposes. Here this is positively related, here it's negatively related. Well, that's already a short and simple introduction to the capital market. And in particular, if we summarize this, we know that in this equilibrium point, the amount that is saved and the amount that will be invested are equal. And the interesting thing now is this equilibrium we can actually mathematically determine. And this works via the expenditure equation. And here we're starting with the expenditure equation for a closed economy. Later on, in the later slide, I also will change this to the situation of an open economy. But let's start with the closed economy version, where we simply have the GDP being equal to private household consumption, investments, as in firm consumption, and government expenditures. With one small assumption, we can also then replace government expenditures with taxes. And the small assumption we have to do here is that no government debt results and the government finances all expenditures via tax income. If this holds, then we can replace the government expenditure with the taxes and use this by subtracting it from the right side, or more or less shifting it to the left side, to calculate the expendable income. The expendable income is basically what you earn minus the taxes you pay. So that's the income you can use either for consumption or savings. So if we argue that savings is whatever you do not consume, we can also easily calculate the savings by subtracting the private consumptions. So if we go minus C, we get this. Then what is given on the left hand side is actually the amount of money that is saved. So we can write this as S being equal to I, or in other words, the money that the households save, bring into the financial market or markets, is then given in the form of credits to companies which use the money for investment purposes. And that's exactly the description of the equilibrium in the capital market. So as soon as this condition holds, this means as soon as we have no government debt and the expenditure equation holds, we will have an equilibrium in the capital market. And that's actually an interesting point to note because, well, here I assumed we have government debt and no government debt. So what would happen if we actually get rid of this assumption and allow for government debt. That's what I want to talk about here. What happens if we have government debt or, and this works in the same direction, we have a tax increase? Well, let's just consider the capital market as before. Now, if we have government debt, we assume that the government issues government debt obligations. So someone needs to buy the government debt obligations. And that's usually, in this assumption, or in this model where we only have households and companies, the households. However, if the households buy government debt obligations, they have less money available for standard types of savings. So for the classical savings account. So the supply, which is actually the savings of the households, will decrease. Or in other words, the supply curve, here the S curve, will move to the left. And it will look like this. Meaning we get also a new equilibrium with a lower amount of capital, but even more importantly, so a higher interest rate. So if we have government debt, this means that via the capital market, we will have an increase in the interest rate. Well, the same thing happens if we have a tax increase, because the disposable income will decrease. And if the disposable income decreases, we'll also have less savings. So the tax increase will also lead to a higher interest rate. So that's the main idea, how we can discuss the effects of government debt or taxes or tax changes in the context of our simple model of the capital market. However, we still have the disadvantage that we're working with a model for a closed economy. So how would the situation change if we allow an open economy? That's actually what we're going to start with here, but we need some intermediate work done first. And that's us taking a look at the balance of payments, which can be simplified as the sum of current account, capital account, and foreign exchange. If for simplification reasons, we assume the foreign exchange doesn't really change a lot, then we can omit this from our calculations, making it a lot easier. And well, this balance of payment is balanced if we get in this sum a result of 0. So using the two assumptions that for, on the one hand, the foreign exchange does not fluctuate a lot, so it's more or less stable, and foreign exchange inflows and outflows are the same, so this balance is more or less null, can be omitted, and we want to have foreign exchange equilibrium, meaning we want to have a 0 as a balance of the balance of payments. This will simplify to this, that the sum of the current account and the capital account has to be 0. This would be foreign exchange or foreign economic equilibrium. And well, we also know that the current account is dominated, especially in almost all industrialized countries, by the trade balance, the trade of goods and services. So here, instead of writing the current account balance, we could also write the net exports. So we can replace this part with the net exports, the difference of exports and imports. We also know the capital account balance or capital account is dominated, especially in a more long-term perspective, by foreign direct investments. So here we can take the difference between capital inflows and capital outflows. Or in other words, we can replace the capital account balance with the net capital inflows. Inflows minus outflows. If we replace the two parts here with these two terms, we'll get this. And what we then can do is simply bring the net capital outflows to the right. This will read as net exports need to be equal to net capital inflows. Well, negative net capital inflows. Well, net capital inflows with a minus in front is nothing else than net capital outflows. So here, our equilibrium condition becomes simply net exports need to be equal to net capital outflows. If this is fulfilled, we have a foreign exchange equilibrium. So operating under the assumption that this foreign exchange equilibrium has been achieved, we can use this formula to replace net exports with net capital outflows. That's something we keep in the back of our minds. Then we return to our expenditure equation, but now to the expenditure equation for an open economy. So we have here, in addition to consumption, investment, and government expenditures, also the net exports. Well, we've seen before on the slide previously that we can replace the net exports with the net capital outflows. That's what I'm going to do here after I summarize this, giving us then here a new equilibrium condition of savings being equal to investments plus net capital outflows. And now we can take a moment to think what net capital outflows actually are. And that's basically investments abroad. So this equation simply states that whatever our households save is either invested domestically or abroad. And that's then the equilibrium condition for the capital market in an open economy. So the only thing which we have to add, if we consider an open economy as compared to a closed economy, is the part here in the back, is that investments can also take place abroad. Well, that's then everything there is to this session on the capital market. So I hope you enjoyed it, and I say goodbye and see you next time.